Hello guys, happy Thursday. Let's just make sure we are live in all the right places. How is everything going? How's everyone doing? If you're watching live, go ahead and let me know where you're. Okay, cool. We're live. Let me know where you're watching from. Usually on the first Thursday, on the first day of every month, we do our Q&A, but I was sick a couple weeks ago, so we're behind. So we're going to catch up. We'll get back onto that after tax season. But yeah, let's jump right in. I got tons and tons of content for today. So let us jump right in. If you're here for the first time, you're like, hey, who are you? Why am I watching you? I am Bree Beers. I own Bree Beers and Associates. We are a tax and accounting firm we're in Denver, Colorado, but we work with clients across the country. I myself am a CPA, a certified tax coach, an advanced tax strategist, a fractional CFO. But why you should trust me is not because of all those titles, because that just means I've passed tests or taken courses. Why you should listen to me is because I have over 20 years of accounting experience. I wrote 14 seasons on here, but I need to look and see if we're in our 15th season or not. Like at some point you stop really counting, but I have over a dozen tax seasons under my belt. And what makes not me unique, but what makes working with a small accounting firm unique is that your accountant not only has the accounting and the tax background, but also the experience as a business owner, as an entrepreneur. So they can relate to you and help you from that aspect as well. So I have owned Bree Beers and Associates since 2017. And for most of that, very shortly after I purchased the firm, I really got into learning the tax code. And not just, I knew the tax code because I was doing tax returns, but really kind of figuring out all these loopholes and the tax strategy pieces that are available to us as small business owners. Started as me looking for myself, then looking for clients, and really figuring out how to take these tax loopholes, these tax rules that are in place that are there for us to utilize, and how do I help everyday business owners utilize those rules. We tend to think of tax savings and tax planning as reserved for the rich and the wealthy. And yes, they are the ones to take advantage of it because they have the resources and the people to make sure they're doing everything to minimize their taxes. But there are pieces of the tax code that are built for and available to us as small business owners. And so that's really what we're trying to do at Bree Beers and Associates, is bring those strategies and those savings tools to the small business owners. Because if you think about it, like if you make the exact same amount of money this year as you did last year, but you're able to cut your tax bill, it's kind of like giving yourself a raise, right? It's kind of, you have more money in your pocket without actually doing more work or spending more money. So that's where we are. So I was sick a couple weeks ago. And when I talk, I still have this annoying cough. So sorry. So I will try to slow down because I think that helps. But today we are talking about common tax mistakes to avoid. And usually, you guys, when we're on these trainings, we are really focused on the tax savings and the strategy, but it is also important to be compliant. It's important to file an accurate tax return for numerous reasons. So first of all, there are the IRS and the state taxing governments, if you're in a state that has state income tax, right? Love to assess penalties and interest. The IRS charges penalties for late filing, for underpayment, for inaccuracies. So, and then there's interest on top of that accrues daily on any unpaid balances, including unpaid balances of penalties. And simple mistakes, you guys, can really lead to some costly fines. So we want to be able to file accurate tax returns so we can avoid penalties and interest. We also want to prevent IRS notices and audits. Okay, they are a pain in the tush. All right, and as we've seen the last few years, since I've been in tax, the IRS has been underfunded, understaffed. It's been a struggle to talk to people at the IRS when you do get these notices. but it's gotten worse. It was terrible in COVID, and it's been really bad since. And now there are staff cuts going on. And so what I see is, because there's less staff, a lot of these notices are automatic, right? They're computer generated. And so I see those coming out just as often, or frequently as they have been, but it becoming harder to contact the IRS and actually get a resolution. All right. So to try and nip that in the bud from the get-go, filing an accurate tax return minimizes the chances of getting those IRS notices and those audits. All right, because inaccuracies can trigger those to come through. And a lot of times, you guys, I talk to people. Last year, I think we had 15 notices we received from clients. And of those, none of our clients actually owed money. All right. Most of them were IRS mistakes. I'm not joking. Like, the IRS loses, I don't know if they lose forms or they just don't process them. But so some of those, we just had to resubmit forms that we had already submitted. Some of those were from clients who were brand new, and their previous accountant had just forgotten to submit some forms, or maybe had numbers on the wrong lines. All right, so we want to make sure that we're providing accurate tax returns so we can avoid as many of those notices as possible. All right, they're still going to come. We'll talk about that at the end. And then also to make sure you get the refund or benefits you deserve, right? And when there's errors, if there's forms missing, if there's numbers in the wrong place, you can get notices from the IRS saying they've adjusted your return and they've decreased your refund, or they owe more, or they send you notices saying, hey, we don't have enough information. We're missing these, forms X, Y, and Z in order to get your refund to you. All right. And also, if you're missing deductions or credits, you're leaving money on the table. All right. So many reasons why filing an accurate tax return is important, right? And most of it's to make sure we get all our money, we don't overpay, and we try to avoid those notices. All right. So I made a list of the top, I think, 5 mistakes that we see either through our clients, like coming, when they come from when we get new clients, and things that their past accountants have done, notices we receive, and also from our accounting community, from other accountants who we see the most common errors with. Okay. And the first one, you guys, is incorrect filing status. All right. This is not one that you're going to get when you work with us, but it is one I see on a lot of accounting forums. And the 2 biggest areas that we see incorrect filing statuses coming from are head of household versus single, and married filing separately versus married filing jointly. All right. So what's the problem with filing wrong? Well, if you file incorrectly, you can either, reduce your refund or increase your taxes, right? Because one filing type is better than another. Or you might, like the single versus head of household, right? To file head of household, you get a bigger standard deduction. It's more beneficial, but you have criteria you have to qualify for. All right. And so I've seen on forums where people are filing head of household when they don't in fact qualify for that. All right. And that's an easy one for the IRS to flag, and very easy for them to come and send you a notice saying, wrong, you took too large of a deduction, you got to refile, or, we fixed it. All right. So head of household versus single, and married filing separately versus married filing jointly. All right. The IRS has tools that help you determine that. If you work with us and you're married, we will always run both scenarios, married filing separately versus married filing jointly. A lot of accountants will do that just to make sure you're getting the most beneficial. All right. But so real quick, to legally file as head of household, there's 3 conditions you have to follow. You have to adhere to. All right. If you're married, this does not apply to you. This is if you're single. Okay. If you're unmarried or considered unmarried on the last day of the year, everything is as of December 31st. All right. So if you're single, you're divorced, you're legally separated, your spouse didn't live with you for the last 6 months, any of those qualify you as unmarried or considered unmarried. Okay. if you paid more than half the cost of maintaining the home, okay? And if you have a qualifying dependent who lived there with you for more than half the year. This could be a child, a stepchild, a foster child, a qualifying relative, okay? There has to be at least one other person, a dependent, okay, that lives with you in order for you to take the head of household deduction. All right. And the benefits of filing head of household, you have a larger standard deduction, lower tax brackets, increased eligibility for some tax credits. All right. And then the other one is married filing jointly versus married filing separately. And we get a lot of clients who want to, they just go, we want to married file separately because different reasons. For some believe it'll reduce your tax liability. Very rarely does that happen because there are a lot of credits and deductions that you only get if you file jointly. But again, most accountants will run both scenarios, all right, to make sure you're getting the most beneficial. We get clients who come in, they go, oh, we want to keep our finances separate for personal or legal reasons, so we want to file married filing separately. I'm not a lawyer, but I do know that filing separately rarely provides legal protection when it comes to IRS debts, unless there's some sort of unless you do the innocent spouse relief claim or anything like that. So that's not really a reason to file married filing separately. What we have clients do is file jointly and just kind of figure out who's responsible for what taxes. All right. One that is legit is student loan repayment concerns. This, depending on your student loans, could be a reason to file married filing separately, but not always. All right. And then divorce, separation, and relationship issues. If you are married on December 31st of any year, the IRS considers you married for the whole year. All right. The only exception to that is if you live apart for the last 6 months of the year and you have a supporting dependent, then you can qualify for HOH, head of household. All right. So that's the number one mistake. And just a few things. The credits and debits that you lose if you file separately versus joint, you tend to have higher income tax rates. You cannot get the earned income tax credit. You cannot get, you're limited on the child tax credit. You don't get the student loan deduction, and you're limited on your IRA contributions. All right, so mistake number 2 is misreporting income. All right, and this is one, I say misreporting, we mean not reporting. Okay, and the biggest thing here, guys, is the IRS matches records that are filed with them. All right. So if you get a W-2, if you get any sort of 1099, whether it's retirement or an NEC, right, for compensation, a 1099-K for collecting credit card payments, a K-1 from a partnership or an S-Corp, all of those documents are reported that are given to you are reported to the IRS. All right. So when the IRS, that is something that the IRS systems, their machines do, right? They look at all the forms under your social security number that they received and they total that income. And if they do not see that income, not only on your report, on your return, but reported in the right place, all right, they're going to flag you. They're going to send you a notice saying, hey, we show income you did not report. We've got a problem. All right. So again, that's W-2 income, any sort of 1099 income, that's NEC, retirement, investment, rental, all of those. If you get a tax document, the IRS also gets a tax document. You have to report that. Okay. Excuse me. The newest thing, you guys, is the Venmo and the PayPal, all of that. You know, so many of you of like sole props out there, people doing side hustles, side gigs. All right. They're taking money through Venmo, through PayPal, through Zelle. All right. And in some ways you're still able, it's not all of that's not yet reported to the IRS. They're trying to change that and trying to make it so all of it gets reported. But there's still some discombobulation, but it comes down to the ethical side of things, right? If you made money providing a good or service to someone, it's income and it should be on your tax return. All right. Okay. Mistake number 3, overlooking deductions and credits. And this is what, I mean, these trainings are all about this. We focus on this throughout the entire year. So I'm not going to spend a ton of time on this, but it is so important to remember that all of the income, right, we just talked about is reported to the IRS. Your deductions are not. Okay, it is your job, your responsibility to reconcile all of the income, that is reported under your social and reduce that legally, but you have to report the credits. You have to report the deductions. Seems backwards, seems like a scam, right? But it is your job. If you want to reduce your tax, if you don't want to pay tax on all of your income because you have deductions or credits or expenses for your business, it is your responsibility to report those. All right. So some of the common ones that aren't business related, you guys, not claiming retirement contributions or education credits if you pay for school for you or a dependent, right? There's great education credits out there. The home office deduction if you work for yourself or have a side hustle. Failing to track charitable donations if you itemize. All right. Which I know a lot less people itemize since the Tax Cuts and Jobs Act increased our standard deduction amount. But if, depending on how much interest really it comes down to you pay on a mortgage, you might still itemize. And if you itemize, you want to make sure you take your charitable donations. All right, those are deductible. So keep records, work with your tax professional. A good tax professional, you guys. The biggest difference between like TurboTax and H&R Block and a good in-person accounting team is that the accountant sees when you're missing things. All right. And I'm not saying every accountant does this. I know there's some bad accountants out there too. But assuming you're working with a good accountant, an expert, an experienced accountant versus, doing it yourself in TurboTax or H&R Block, or even having someone at one of those firms do it, they're data entry. Okay. A tax professional like me and my team and all of my accounting colleagues, we will take the information you send us, we look at it, and then we fill in the gaps. We will ask you like, hey, you had a business, but you didn't take home office. What's the deal? So ask your tax professional. They're going to help you make sure you take your deductions and your credits, right? Hey, you have a kid, but there's no dependent care. Did you pay for daycare? Oh yeah, I did. So that's important aspect to look for in a good accounting professional. All right. So mistake number 4 is math and data entry errors. And this goes back to what I said at the beginning. This is the most common reason that we see IRS notices. All right. Simple mistakes can trigger IRS notices because the IRS, their system is set up to see certain income, see certain numbers on certain lines. And if you're missing something or you have it on the wrong line or you're missing a schedule, they're going to kick back and tell you that either you don't qualify for that or you're missing, they are going to send you a notice saying, we have a problem. All right. So common errors. We've seen mistyped social security numbers. I just got a new client this year whose prior accountant, H&R Block, put their social security number in wrong, which usually the IRS system does not allow that. So I don't know. Birth dates, bank account info, that's a huge one, you guys. In today's world, I do not recommend to any of my clients that you request a check for a refund or you mail in payment for balances due, because between the post office not always being at its, on the top of its game and the IRS just losing shit, excuse my language, losing stuff. All right. And I'm not joking. They just lose things. Your payment may never get there. The check may never get to you. So I always recommend, using the direct debit or direct deposit, but you got to make sure you have the right accounting info, right? Transposing numbers and income figures, right? We've seen, 89,000 written in instead of 98,000. That's a problem. So, if you're doing this on your own, double check your numbers before submitting. Use that tax software and hire a professional. Because what's cool about hiring a professional is if they are the ones that make the mistake, they'll fix it, or they should. I have never met an accountant who, when it wasn't their issue, they didn't fix it for you guys. All right. So the last mistake that I put on my list, and then I'll go, I have a couple that the IRS, like IRS's top mistakes, is filing late or not filing at all. All right. And for most people, this is not something we do intentionally, or we're not trying to avoid paying taxes. We're not trying to avoid, we're not aiding, I don't know what the word is. We're not purposely trying to be fraudulent, right? We just, life gets busy. Taxes aren't a priority. Maybe sometimes we know we're going to owe a lot of money and we just shut down and we're like, yeah, I can't deal with that right now. Like, not going to happen. I can't pay it. All right. For whatever reason, we get, so many people, they get behind, or they, so they're not filing at all, or they're filing late. But you guys, let's, if that's you, no shame. It happened. We get some of the best clients who just, it didn't, just doesn't. That was Alexa. So why does this happen, right? Why do people file late? Why do people not file at all? So sometimes we underestimate the time needed to gather our documents, right? Especially if we don't just have W-2s and, if it's not just a matter of receiving documents from our employers and our fund houses and giving it to the accountant, but it's, compiling business expenses, or going to the daycare and getting the tax statements, finding the tax statements, even just finding the tax statements from everyone, right? Sometimes they mail it. Sometimes you have to log in. It can just be overwhelming. And a lot of times we were like, oh, we'll do it. And then life happens, right? So that leads to not filing or filing late. But the first thing, if you take nothing away from today other than this, always file an extension. Okay. If you cannot file your taxes on time, that means your S Corp, your partnership by March 15th, your personal return or your C Corp, there's none of those in here, but your personal return by April 15th. If you cannot file by then for whatever reason, file an extension. That gives you 6 months. All right. Because the failure to file penalty is 5% of what you owe. It's the biggest penalty of them all. Okay. Whereas the underpayment, the payment penalty, the failure to file penalty, those are much smaller. Okay, so file an extension if you cannot file your completed return by the deadline. All right. The other part is people are like, well, I don't want to file because I can't pay right now. File and get on a payment plan with the IRS. Okay, because the thing is, again, if you don't file, it's the failure to file penalty is the biggest of them all. All right, so you want to avoid that. That's easy to avoid. All right. So you file, you get it filed, you know how much you owe, and then you get on a payment plan. Okay. And that does not avoid interest, but it does avoid you from being non-compliant with the IRS. All right. All right. So the IRS's top mistakes are filing too early, which to them means you submit your tax return before all the necessary tax documents come in. That is one that we sometimes, I'm trying to think, I think we've seen it maybe once or twice with a new client, just like a one-off, but this happens out there because people think they have everything they need. And then because W-2s have to be issued by January 31st, right? So sometimes we think everything needs to be issued by January 31st, but that's not the case, right? Our brokerage statements, if we have investments or retirement, those aren't required till February. And even then they're not always on time. If we have a business and we're waiting for a K-1, those don't have to be filed till March 15th. And even then, the business we're waiting from, they can file an extension. Then they don't have to file till September. All right. And if we forget about those things, we're going to file a return and then we're going to get those forms later and go, oh man, screwed that up. And we're going to have to amend. All right. So it's important just to know. And if you have a tax preparer, they're going to have your list from last year of everything you had. So they're going to say, hey, last year we had 3 K1s. This year you only sent me 1. Oh yeah, you're right. We have to wait on that one, right? You don't have to remember that if you have a tax preparer. They should be helping guide you to make sure you have everything before you file. So filing too early, meaning we're filing without putting all of our information in, all right? And if we do that and we don't catch it, we're going to get those notices saying, hey, you forgot W-2 income. You forgot 1099 income. Oh, we have this K-1. You didn't report, all right? Number 2 is incorrect bank account numbers. I already said this, but I've seen this, and it's the IRS is number 2 mistake. That can delay refunds, result in misdirected funds. If you owe money and they aren't able to take it out on time, you're going to accrue some penalties and interest. So make sure those bank numbers are right. Whether you're doing your own and you're putting it in software, or you have a tax preparer, when you work with a tax preparer, before you sign off, double check those bank account numbers and routing numbers. All right. And then unsigned forms. This is not so much one for our clientele because we e-file everything. But if you have to paper file stuff, making sure all the forms are signed. All right. So those are your mistakes. Those are the mistakes that are made. Sorry, I see your question. I'll get to it in just a second. One thing I recommend, you guys, and this is something that we have always, so whether you use software or you use an accountant, all right, if you use software, pay for the audit representation or the audit protection, all right, especially, again, in today's society, like I've said, we're seeing so many IRS notices sent when there's not actually money due, right? There was an error of some sort, maybe by the tax preparer, maybe by the taxpayer, maybe by the IRS. But dealing with the IRS right now is no joke. It's a full-time job, all right? To the point that a couple of years ago, we used to do our own audit representation for our clients, right? Clients would get notices. We would call the IRS. We would, deal with it. Now we have a third party that does an amazing job, handles it. They do it for our clients. I recommend, so if you're hiring someone, ask them about that. Do you offer audit protection? What does that look like? Because you do not want to be sitting on hold with the IRS for hours, days. I could do a whole live on the horrors of dealing with the IRS, getting disconnected, getting hung up on, having systems down. And not all accountants do it, and when they do, think about it. Like if you get a notice in the middle of March and you send it to your accountant, they're in the middle of tax season. They do not want to deal with that IRS notice, right? They're not going to, but we have a third party that does it. A lot of accountants use a third party that deals with that. So I recommend, it's a great investment. Usually if you're doing your own taxes, it's like $50 or something, but that pays for itself with one notice. All right. So Esther says, regarding educational deductions, let me put you over here. How do we know what qualifies? And also, how do we account for educational expenses before starting an LLC, startup costs versus after? Okay, 2 questions here, Esther. So there's education related to running your business, right? Like continuing education. And then there's education credits for going to a qualified 4-year college and pursuing a degree. All right, so the lifetime learning credit and the American Opportunity Tax Credit, those are educational credits that are available to, you don't have to be a business owner. They're available to everyone, or not everyone, but they're available to most people. And there are requirements. And we're going to do, I think, a educational training. I can't remember when. I don't have my list for me, but we're going to talk about these. So typically, yes, I could use it for myself if they have limitations, right? The AOTC, the American Opportunity Tax Credit, you can only take for 4 years for you. So if my parents took it when I was, 18, they took it for my first 4 years. If I went back to school now, I couldn't take that because it's a lifetime credit. There's the lifetime learning credit. It's a little bit less, same, but like going to college. But for a lot of us who are in business, right? There we go. And we're continually doing continuing education, right? I'm taking courses for my CPA license, right? I have to take 40 hours a year. I have to take those credits. Maybe I'm taking a credit I'm getting certified, right? When I got my certified or my advanced tax planning, when I got my crypto tax, those were all continuing education that are just business expenses. They don't necessarily qualify for the credit outside of the business, but they are a business expense. So how do you account for educational expenses before starting an LLC? Startup costs versus after. So what we want to remember here, this is even more general than continuing education. This is any sort of expenses, you guys, when you're in a business, you're starting a business. Your first day of business is not the first day you make money, right? It's the first day you're able to make money, right? Because a lot of times there is a delay, right? Between the day we open the doors and the day we actually bring our first dollar in. All right, so the first day where I can say, yes, I could take on a new tax client. I could take on a new, who else? I'm trying to think of something that isn't in the service industry. I'm so bad. But the first day that you could actually help somebody, right? And you could go make $1 and you could send an invoice, that is your start date. All right. Anything before that, right? If you're not, so maybe you're opening a shop. Okay, this is a great example. You're opening a shop. So everything up until the day you open the doors, those are all startup costs. And that might include some educational expense, right? You might take some courses on how to run a business. Anything that is before the day you can actually start making money is called startup costs. And those are all lumped together. All right. And with your startup costs in the first year, you're allowed to take $5,000 as an expense in the first year. And then you have to amortize the rest of it, meaning you have to take a little bit over time. I think it's 10 years or 15. I can't remember. Something your accountant can help you with. If you guys have been here, you know that if you have a business, I recommend you having an accountant to help with things like this. The other thing is before you start up, right, you might be buying machinery and equipment. That's different. Okay. But again, Esther, your question is about educational expenses. So if you cannot yet make money, right, maybe you are opening a shop that the doors actually physically have to open in order for you to help a customer, but you take a business class before that, it's going to get rolled into your startup costs. If you are able to open the doors and you take it that day or after, then it's just a business expense. Okay, cool. Great question, Esther. So, all right, you guys, let me see. Did I get through everything? Yes. Okay, cool. A few reminders. I'm a little over. Sorry. If you have an S Corp or a partnership, your tax return is due March 17th. That is just over, what is it? 10 days. It's not this Monday, it's next Monday. All right. So if you have an S Corp or a partnership, your tax return is due on March 17th. If you're not ready to file an extension. That'll give you till September. All right. C Corps and personal returns. So all of my other businesses or all my other people out here who have just your LLCs or your sole proprietors, anything like that, your returns due April 15th. Again, if you cannot get everything together or you know you're not going to get everything, file an extension. If you are a client of ours, please remember that, and I know you've seen all my emails, but your stuff needs to be into our team by March 24th in order to ensure timely filing. All right. And then if you are not a client of ours, but you are interested in working with us, but you missed out on this tax season, join our wait list. The link is somewhere in the comments or in the description, and you will get on our wait list to be the first to know about tax planning. That calendar will open up probably mid-May. So if you are interested in having our team do a free tax analysis for you, what that means is we look at your tax picture and we say, here's some strategies you could implement to save you some money, and here's how much you could save. If you want us to do a free tax analysis, get on our wait list so you can be the first to know when that calendar opens up. So next week we will do Q&A. Okay. So come live, bring your questions. Those get first priority. If you know you can't make it or you don't think you can make it, message us on Facebook. Message us on Facebook with your questions, and my assistant, my VA will compile those questions for me, and I will answer those. And then I have a few left over from last Q&A that I can answer as well. So I think that's it. You guys have a great week. Thanks for joining me, those of you that joined live, and I will see you guys next week. Bye.